Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. It's been some time since we have done a full detailed chart breakdown, especially since in the past few weeks we've been posting Wyckoff introduction videos. So in today's video, we are back with another high risk to reward trade breakdown, talking about Euro versus Canadian dollar, which has achieved over a 1:80 risk to reward ratio. I honestly believe this breakdown will help a lot of you have amazing breakthroughs, as this is probably one of the most rewarding trades I have ever taken. And by that, I don't mean the monetary side of things. I mean how beautifully the analysis from the higher time frame to the lower time frame played out, and how many times you could see multiple accumulations and reaccumulations in this breakdown. So for your sake, please put distractions out of your mind for the duration of this video and pay close attention to what is being mentioned. Topics of discussion today will be detailed top-down analysis, institutional candles, accumulation and reaccumulation at higher time frame institutional candles, and where to not have your entries at. So let's go ahead and jump straight into it. There are quite a few screenshots that I will show just because I wanted to document the trade as well as I possibly could, and the thought process behind it, to be able to give you all a very detailed breakdown. But let's go ahead and jump on the actual charts and start off from the weekly time frame. I'm on forex.com right now as a data feed. The rest of the analysis will be on FXCM. The reason I'm on forex.com now is because the FXCM data feed right now has a lot of my analysis on it, and we wouldn't be able to see the weekly point of interest extremely clearly. On the weekly time frame, it's very kind of straightforward. We just have a weekly institutional candle in the middle of the range that we have rejected, and the entries came into play based on this weekly institutional candle. However, the major analysis started based on the 8-hour time frame. So we are back on the FXCM data feed right now, and this is where the first screenshot would actually come to play. So this was taken December the 10th at around 4 p.m. UK time. Currently, it's Saturday 19th of December that I'm recording this video. Is probably going to be posted tomorrow, Sunday the 20th. But this was the 8-hour structure that was seen for Euro versus Canadian dollar. I'm going to break it down a little bit more on the actual charts, but generally, as you can see here, based on the weekly higher time frame institutional candle, that was also followed through in a way by this 8-hour institutional sell before you buy, which we traded into. So let's go ahead and have a look at a few different things on the 8-hour time frame as that was taking place. It wasn't just the 8-hour institutional candle. It was the fact that as we were approaching this weekly range, this red box over here is the weekly institutional candle that we spoke about. As we approached it, we had signs of a bullish market. One of the major signs of a bullish market is the manipulation of the previous lows, and following that, you start to get breaks of structure to the upside, and you'll start to see that the market is trending to the upside. It was a little bit more than just that 8-hour institutional candle. It was also the fact that that institutional candle was created when we manipulated the previous lows and started to challenge structure points to the upside. And as we started to approach that 8-hour point of interest, we simply wanted to see if we have further signs of a bullish market. And what the further signs of a bullish market would be, in my personal opinion, if you have the higher time frame confirmations. In this case, we had the weekly institutional candle and an 8-hour institutional candle manipulating the lows, breaking structure to the upside. I simply want to see lower time frame follow through of all of these higher time frame bias as well. Oftentimes, we would be able to see the lower time frame confirmations as some type of a Wyckoff schematic. So you can imagine, just before we started to approach that institutional candle on the 8-hour time frame, I wanted to see if on the lower time frames we are going to get signs of accumulation and the validation of the accumulation, so the break of structure which would confirm it. And let's go ahead and look at the second screenshot right now. And this was taken on the same day, just an hour after, and this is now on the 30-minute time frame. As we approached that 8-hour point of interest, we started to get signs of accumulation. So let's go back here and let's have a look at that on the 30-minute time frame. This is the accumulation that started to form as we started to approach that 8-hour point of interest. So remember, that's the 8-hour point of interest. And as we started to approach it, we started to see signs of accumulation. By the way, if this is not making sense right now, I would highly recommend go and watch the institutional candle video that I have posted on my YouTube about, what, 2-3 months ago, and also watch the Wyckoff introduction videos, and believe me when I say this will make a lot more sense when you come back to it. But this is now that 30-minute or 15-minute or whatever time frame accumulation that started to form as we started to approach that 8-hour point of interest. Now, a lot of people would say, couldn't we actually snipe this at the spring over there? You perhaps could, but if you were going based on the 8-hour time frame, your stops would have had to be at least over there. And I don't know about you, but I am not trying to execute with an 83 pip stop loss anymore. I used to back in beginning of, let's say, 2019 or in 2018, before we started to look into institutional concepts more and more and more, but not anymore. That's way too big of a stop loss in my opinion. So as we can see over here, when we have identified this accumulation, I simply said wait for the validation of that accumulation, and the validation of the accumulation would be break of structure to the upside. We have all signs of accumulation as we are approaching that level, from your selling climax, the automatic rally, secondary test, that sign of strength that's not normally on the schematics, multiple secondary tests in the middle of the range, secondary test in phase B, and the spring. So the accumulation schematic was complete, but if and only if we break structure to the upside, I would consider some buy position. And through this move higher, this was indeed that break of structure to the upside. This was that, in a way, proof that this can go higher. So you can actually have a look at the structure points as maybe these structure points over here. You might have even wanted to see breaks of these more major structure points to the upside, and quite frankly, even if you did wait for these higher structure points, you would have been fine. The trades that we executed was actually after we got a break of these higher structure points to the upside, so it was even more confirmed. So this is where we can have a look at the third screenshot. This wasn't necessarily kind of a major point in the analysis, but as we started to move away from that spring and started to little by little challenge structure points to the upside, we created this bullish trend line that I personally didn't really like the looks of it. Now, there's a difference between expecting the market to do something versus reacting to what it does. So what I have drawn over here is if and only if we start to break below that trend line and maybe get some type of a lower time frame accumulation, then we can go ahead and actually take the trades based on that. Generally speaking, what I wanted to see, and if I did see that, it would have, in my opinion, made the accumulation even more confirmed, is if we started to pull back to certain areas of demand down here and then have a rally higher. And this is indeed what got printed on the chart, similar enough to it, where as we started to have this rally higher and higher, breaking structure to the upside, then eventually coming back down to manipulating this bullish trend line, pulling back to previous areas of demand. Clearly down here, we have areas of demand. You can see that as an institutional candle form over here as this final push to the downside before we had the rally. So you can consider this your pullback to demand or your last point of support within the accumulation. Let's say at this stage, if you're still not sure, if you're still not confident about the accumulation, you can wait. And once we start to see this strong rally away, and especially lower time frame reaccumulations, which I will speak about a little bit later, that should have given you the confirmation that you would want. Now, I just want to very quickly go back to the actual accumulation schematic, because I want to speak about a point that I didn't necessarily speak too much about in the accumulation introduction video. However, I'm going to break it down a little bit over here. In the actual schematics, generally what it's shown is as we start to break above the range of this accumulation schematic, you can start to get some type of a lower time frame consolidation before this goes higher, and this can now be considered as another last point of support. Sometimes you will see that this little consolidation that takes place on that accumulation schematic is simply a lower time frame reaccumulation, and if we can see that lower time frame reaccumulation, there is not much need for this market to come back down and, for example, mitigate these institutional candles in the middle of the range. And this is exactly what took place over here. So let's have a look at it, for example, on the 2-hour time frame. A lot of people would have seen this 2-hour institutional candle and would have waited to trade it market based on this 2-hour institutional candle. This is now you expecting the market to do something rather than reacting to what it's giving you. So never stay married to your directional bias. Even if you go ahead and identify this institutional candle, you have to keep an eye on the market to see if we are going to be reaccumulating on the lower time frames. You have to take your trades based on those. Hence why I personally didn't really want to wait for this institutional candle, and the worst case scenario would have been I was mistaken about this reaccumulation and I would have hit stop loss over there and probably would have been able to redeem myself with the trades taken based on this institutional candle. But the confirmations were speaking about a reaccumulation here, which we're going to speak about now, and taking trades based on the reaccumulation rather than these higher time frame institutional candles. So after this screenshot where we kind of expected it to come lower and then go higher, this is now the next picture, which we pulled back to the areas of demand. That last point of support had this rally higher, and the area that I have got boxed up over here is simply that BU/LPS on your accumulation schematics. And this is the same area that is a lower time frame reaccumulation. As this is forming, we now have, in my opinion at least, a full confirmation of that accumulation, especially because it was based on higher time frame points of interest. A weekly institutional candle followed by an 8-hour institutional candle, lower time frame accumulations. As we approach that institutional candle, a minor confirmation of that accumulation as we started to break structure to the upside, pulling back to create that demand and then have this rally higher, and then creating this lower time frame reaccumulation range, which we can see based on this next screenshot over here. Now this is the same area marked up on the 2-minute time frame that we saw over here on the 15-minute time frame. So this is the exact same range, exact same zone, and this was taken on December the 16th at 7 p.m, just after 7 p.m. UK time. This is your typical reaccumulation scenario where the market creates the buyer's climax and has a move to the downside, which we normally would label this as a sign of weakness in a distribution, but in this case that's our shakeout. That's the market shaking out all of these early buyers, people who would have been using that level as a zone of support. The automatic rally back up after that shakeout in a way to tap into these previous areas of supply for it to have room to perhaps create the low of that range, which we would normally mark it up as spring. This could be your creek beforehand, where it would simply be a line connecting the highs of the range of the market before we created that spring. Or this sometimes can actually form instead of the spring, or it can form multiple times in the same range as it starts to break higher and higher. But generally speaking, this reaccumulation range should have been the reaccumulation range that you would want to trade based on, simply because it's giving you everything for you to be more confirmed that potentially we're going to have the rally higher from that lower time frame reaccumulation. So let's go to the 2-minute time frame. It was giving you everything you needed for you to be able to see that, okay, do you know what? This is actually reaccumulating, and we've started to move away from that reaccumulation, breaking these minor structure points to the upside, so we can most definitely trade based on this. Now, sometimes I say you can actually wait completely for this entire range to be broken to the upside, but as you study these concepts more and more and more and more, you will understand that sometimes you can actually go based on minor structure breaks on the lower time frames, and you can actually take trades based on that. There was one more thing in this range that also made me a little bit more confident that this trade will most likely play out, and that was a 15-minute institutional candle forming literally at the bottom of this range. Now, this could be a tough institutional candle to mark up simply because not everyone would be considering this an institutional candle, especially because we didn't have that very quick move that we would normally see after institutional candles. But this is very much a valid institutional candle for multiple different reasons. This sell candle that got formed over here most likely enticed a lot of traders to want to sell the market. That created a lot of fear of missing out. That was the candle that resulted in a lot of people just opening random sell positions, or maybe waiting for it to come up to the same range of that institutional candle and take it to the downside. People would be considering this a zone of resistance on the lower time frame and would be taking trades based on it. So although it might look like that candle in itself didn't necessarily take any liquidity, at the end of the day, it did entice a lot of people to actually want to sell the market. And when we started to move above that institutional candle, then indeed we can actually look at the open price or the wick of the institutional candle to the 50% of the body, so that we have a range that we can take trades based on. Yet again, you could have have taken the trades based on the high of this institutional candle with your stops at the low. That's a 30 pip stop, which is much better than the earlier 80 pip stop that we were looking at. And I would recommend, if you're new to these concepts, for now, do that. For now, there's no reason going lower than the 15-minute time frame. Look at the higher time frame and take trades based on them. And when you get confident, start to look at the lower time frames. In this specific breakdown, we're actually going to go down to the 15-second time frame because I want to prove to you all the fractal nature of the market. I want to prove to you all what you see on the monthly, you can see on the second-based time frames as well. So let's go back to the 2-minute time frame, have another look at this reaccumulation. And not this one, it was this reaccumulation over here. So the screenshot that we showed about this reaccumulation, we ended up coming a little bit lower after that spring, so creating another low, which was this one after that spring. Either way, it didn't actually affect our analysis because after that, I would have wanted to see breaks of at least the minor structure points to the upside to trade based on. This move to the upside that we had straight after this initial low that we identified at spring did not really challenge any minor structure points. So this is now where we can have a look at the next screenshot, which is based on the 15-second time frame. So the range that you see over here, this red box, is the 15-minute institutional candle that we were speaking about earlier. And as you can see on the 15-second time frame, in this case, it's as if everything was taken care of. The market kept pulling back to mitigate any institutional candles that was left open, and the price was very well taken care of up until around here, up until this region where we created this institutional candle on the 15-second time frame, mitigated the previous institutional candle in the middle of the range, and then had the rally higher. That was, in a way, the final institutional candle that was created, which held this entire rally on its shoulders. So simply, I wanted to see a mitigation of that. So let's go to the charts, let's put this in replay mode and have a look at it on the 15-second time frame. Hopefully TradingView will let me. Yes, it will. Good, good, good. So this was the 15-second institutional candle that we were speaking about. I'm gonna elaborate on what I said a little bit earlier again, where every time this market pulled back, in a way, it filled in whatever inefficiencies were there and it mitigated whatever institutional candles it needed to mitigate. It was very clean. The price was properly taken care of up until here. That was the final institutional candle, pushed its way to the downside, mitigated this previous institutional candle, and then had the move higher. So it would have been phenomenal to be able to see the market mitigate that institutional candle, and we'd be able to take our trade based on that institutional candle. You can imagine the entries would be at the top of the institutional candle. In this case, the range that I identified was in a way the high of the previous candle to the low of that candle. That was the range that the institutions most likely had a quick sell before buy action over there, which is no surprise to see later on we do come back to mitigate that exact same level. This was the first scenarios with a 2.7 pip stop loss. These are the same entries over there, 55234, 55207. 55234, 55207. These are the same entries, same stop losses, and these were the first entries which currently is sitting at a 1 to 50 or just over 1 to 50 risk to reward ratio. It was the re-entries after this that actually went over a 1 to 80 risk to reward ratio, and that was based on the 30-second time frame. So before I go ahead and show the documentation for that, I want to very quickly speak about this general structure that is now created. I want you to be able to see very clearly everything that has taken place over here we have taken care of now. We've even pulled back to mitigate this final institutional candle, that final range that needed to be mitigated. So in a way, the chance of a bullish market is a lot higher than a bearish market for many different reasons. Not only this 15-second structure, but also the 15-minute institutional candle that we had, the 2-minute reaccumulation range, and all of these were based on a higher time frame accumulation and points of interest. So all of these things, again, are important. You can actually look at this range as a smaller time frame accumulation range as well. Feel free to go and mark this up on your own. It will be a lot easier to mark this up as accumulation schematic number 2, but you can even see how we've created lower time frame accumulations and we're continuously moving away. The order flow most definitely in this case is bullish, and we have to trade with that order flow. There's no reason for me to now constantly be confused thinking, oh, what if this comes lower, or what if this, or what if that? We've had enough confirmations for us to want to trade this accordingly. So now let's go up to the 30-second time frame. And I know a lot of you might not have access to the second base time frames. I don't want you to see this as, oh, you need the second base time frames for you to actually trade with high risk to reward. You don't. Majority of my trades are not based on the second base time frames, to be completely honest with you. I just want to show you that there is no specific time frame. So long as you can see the story that the market is telling you from a higher time frame to the lower time frame, everything else is fractal and you can go based on that. Even on the 30-second time frame, you can see that 15-second institutional candle is looking like this rally-based rally formation. Normally we look at rally-based rallies on the higher time frames, but again, the markets are fractal. They do apply to the lower time frames as well. So let's speak a little bit about the 30-second entries, and that was the 15-second, and this is the 30-second re-entries. As we started to move away from those first entry points based on the 15-second time frame, the market started to trend and started to create even lower time frame signs of accumulation over there. There was no reason, there was no need for this to then come lower over here. Why would it need to? Everything else is bullish. Everything else that we spoke about is pointing towards a bullish bias for this market. So when we see on the 30-minute time frame, there's another institutional candle created over there, I would be more than willing to take the risk on that. And I would be more than willing to put my entries at the top of that range with the stops at the low. You might ask yourself, how comes you didn't go based on the open price? How comes you didn't go based on the 50% of that institutional candle? We are looking at such low time frames that we don't necessarily need the market to come to the 50% of that institutional candle. The safest entries would have been at the high of that institutional candle at the top of the wick with the stops at the low. And this is exactly what I've documented over here. So 55274 and 55257. 55274, 55257. So in this screenshot, you can actually see the same entry, same stop loss, the same institutional candle before we had the move higher, and this is the date and time. If you want to have a look at that in your own time, put it in replay mode and study that for yourself. And the expectation was that we can mitigate the high of that institutional candle, and as long as we have our stop losses at the low, we should be okay, which were the second entries over here with a 1.7 pip stop loss. Zoom out a little bit so we can actually see the stop loss a little bit easier. There we go. That's our 1.7 pip stop losses that we actually achieved on the 30-second time frame. And I'm going to speak shortly about the take profits as well. Before I speak about that, I want to very quickly speak about spreads, because EuroCAD is one of the currency pairs with slightly higher spreads. If you haven't watched the video about the secret of spreads, make sure to go and watch it. That video will answer a lot of your questions. I'll link it in the description below. But in this specific case, the spreads at the time of execution for EuroCAD were, if I'm not mistaken, less than half a pip. On some brokers, you may see 2-3 pip spreads for EuroCAD, but this is the importance of having true ECN or raw spread accounts and going with a broker that not only is legit, not only is registered, but also has a good customer service, good deposit and withdrawal methods, and excellent spreads. Again, I recommend you to go and watch the video about the secret of spreads. That should answer a lot of your questions. But these were the entries over there with the stops at the low, which is now phenomenal to see that we have quite literally moved away from that level quite aggressively and quickly and impulsively. After this, we did get a little bit more slower market as this was doing its thing, constant ups and downs, but this was the range that I just kept the trades open during. It was this move over here that we started to move a little bit more slower, but this was during the Asian session where we started to move a little bit slower. As we started to approach London Open, we in a way pulled back, not exactly to either of the entries, but pulled back, in my opinion, to mitigate some previous zones of demand, and not only that, simply to manipulate certain lows over here. And once that was done, oops, let's put that back, there we go. And once that was done, we indeed got the rally that we expected higher. I will also speak about another reaccumulation and accumulation that took place a little bit later on. But before I do that, I want to speak a little bit more about take profits. So that's not where I have my take profits in place. I took some partials a little bit earlier. Trades are broken even. I need everyone to understand that we don't keep all of the positions open until it hits the final take profit. That's not necessarily the smartest thing to do, especially when you're looking at high risk to rewards such as 1 to 80s, 1 to 100s and above. There's no need to keep all of your positions positions open the entire way. We most definitely take partials along the way. One of the points that is important in this specific case to take a lot of positions off the table is this blue area that I have marked up over here, where we can clearly see that previously not only we filled in previous inefficiencies and mitigated institutional candles over there, but this was the move that in a way manipulated the previous high before we had the move to the downside. So in itself, that can be a zone of supply, and as this market approaches that, we could see a complete reversal. I want to be protecting myself against that by having a lot of positions closed before then, having the rest of the positions at broken even, and then simply letting them ride. So always there will be positions at break even that I'll just let it ride. Oftentimes, even without a take profit, I will have an idea of where is the highest point I'd be willing to take my profits at. In this case, it will probably be around the 1.6 region, where if we approach that level or even a little bit higher, chances are I'll close the entire position, and with a big smile on my face, I'll be very happy to have achieved that type of risk to reward. But before that, we do take partials. If you want to know where you could be taking your partials, now this depends on the style of trading you have. You could be taking it at the low of this range if you are maybe trading break and retest scenarios, or maybe you want to say, I want to take my profits at these highs over here because it might create equal highs and drop, or whatever it may be, or you might want to base it on the 50% of that institutional candle over there. Oftentimes, I just go based on the risk to reward. When we achieved around 1 to 60, 1 to 65 risk to reward in this case, I was happy to close a lot of my positions, break even the rest, and letting them run, letting them do their thing. I don't want this video to be too long, so let's quickly speak about the second reaccumulation range that was formed as we started to move away from those lower time frame entries, and let's start to break these down as well. Now, I'm not going to take any credit for any trades taken based on these because I didn't. I just documented these just to be able to kind of show you that as long as you have a higher time frame story, you will be able to see the lower time frames continue that story, give you more confirmations as this moves higher and higher and higher. And this is where we get to the last screenshot. I know there's 2 more tabs over there, but I'm not going to show you these 2 yet. I might keep them for another video. We'll see. But this is the 1 minute reaccumulation that was formed as we started to move higher and higher. And the documentation over here is simply for you to be able to see when you have a higher time frame narrative. In this case, again, the weekly time frame followed by that 8-hour time frame and the 30-minute accumulation and breaks of structure to the upside, and then the lower time frame reaccumulations and the move above it, and so on and so forth. Then the market continues to give you more and more confirmations that it's going to continue going in your desired direction. And if it doesn't, that's one of the other points that you can close your entire positions and be safe. This is a screenshot of another reaccumulation, which is, again, a very textbook markup from the buy-in climax down to this shakeout. Then the automatic rally that we get after that shakeout, again, to tap into these previous areas of supply to have enough momentum for it to either be able to create the low of the range, which we label as the spring, or be able to at least manipulate certain previous lows before it goes higher. And again, if you want to study this in your own time, this is on the 1 minute time frame, 17th of December at midnight UK time. So let's say 11:54 p.m. UK time it would be. So let's go ahead and have a look at that on the 1 minute time frame as well. This is now the same picture that was shown on this screenshot over here. So this same reaccumulation is what we can see over here. And as you can imagine, as we start to move higher and higher and higher, you can now consider these minor breaks of structure to the upside. It's not the best looking break of structure because we didn't really properly challenge these minor structure points, or even the structure point that was a little bit higher than this. In this specific case, it was the accumulation that took place even on a lower time frame after that, which in my opinion confirmed this entire reaccumulation range. It was interesting to see that we moved away once we created the low of that range. However, we did indeed move back to, however you want to label it, whether it be manipulation of the trend line, whether it be manipulation of certain lows, whatever it may be, the entire point is it moved back to do exactly what an accumulation does, which is manipulating the lows and moving higher. And if we have a look at that, if I'm not mistaken, on the 30-second or 15-second, we can see signs of a more clear accumulation. Let's have a look at that on the 15-second just to have a little bit more room if you want to mark it up. There we go. So you can literally label this as selling climax, automatic rally, secondary test, sign of strength. All of these would be your internal secondary test. You can label this as your secondary test in phase B. Maybe you were expecting a spring to take place, but then as we started to break above the range of this accumulation, then you would have known that, okay, do you know what, we're probably not going to create that spring. The reason I wanted to show you this 1 minute reaccumulation after another reaccumulation and even a lower time frame accumulation is to prove what I always talk about, which is patience. Even if you waited for this entire move to happen and break outside of this entire accumulation range, if you were looking at it on the lower time frames, chances are you would have actually been able to take some trades based on these reaccumulations or accumulations and catch these moves to the upside. You might say, okay, but that's not a lot of pips, but since you're looking at the 1 minute or 30 second or 15 second time frame, your stop losses are going to be very small. So even if you catch 30, 40 pips, you're going to have phenomenal risk to rewards. I want to recap very quickly what we spoke about in this specific breakdown. First, it started on the weekly institutional candle. We had this weekly institutional candle in the middle of the range that, as you can see, we mitigated and moved away. Following that, looking at the same region on 8-hour time frame, you can see as we approached that weekly institutional candle, this red box over there, we manipulated previous lows, and once that was done, started to challenge structure points to the upside. If you've been watching my other videos, you probably know that I always talk about manipulations and what happens after. This is a manipulation, and what happened after is in a way proof of a more bullish market. As that took place, we created an 8-hour institutional candle, which looked very attractive at the bottom of this range over there, especially because we did move away significantly from that level. And as we moved down to mitigate that 8-hour institutional candle, again, we kept manipulating the previous lows. From here, we went to the lower time frames, 30-minute time frame, and we saw exactly what we want to see at higher time frame points of interest. Lower time frame accumulation or distribution. So in this case, as we started to approach that 8-hour institutional candle, we manipulated previous lows. It started to form accumulation schematics. But if you were looking at it over here, this is still not confirmed. We still don't know if this is a valid accumulation. Hence why we waited for the validation of that accumulation. So 8-hour institutional candle, the accumulation, and we waited for the validation of that accumulation, which came into play after we started to break minor structure points to the upside. The minor structure points that we spoke about were these ones over here, where we started to challenge these structure points higher. Still not fully confirmed in my eyes. Still, we could see more confirmations for us to be certain that yes, this is worth buying to the upside. So after seeing that we pulled back to previous institutional candles at the bottom of the range, this institutional candle that was created literally where the spring is, right there, this sell institutional candle, and we can see the rally higher after that as well. That was quite interesting to see because this was the exact region that we started to manipulate these previous bullish trend lines, or even reach below these lows over here to grab whatever liquidity, tap into previous areas of demand, and then see this move higher. Now, as this started to move away from that final zone of demand, we started to create this BU/LPS, which on the schematics, you can see it has just the consolidation at the high of that range before that goes higher. That was the consolidation that we saw at the high of that range, and that's the screenshot for it, where that was the reaccumulation on the lower time frame that we managed to identify. From there, all we did is we went to the lower time frames. This was a 2-minute reaccumulation, had a look at this reaccumulation it was over here, and this is the documentation for that reaccumulation. Buying climax, shakeout, automatic rally to tap into previous areas of supply, spring creating the low of the market, creek before that, and now we've started to move away from that. We just wanted to see some minor breaks of structure to the upside, which came into play over there once we started to challenge these structure points. Parallel to that, at the same range, we had a 15-minute institutional candle, which you can see this huge bearish engulfing candle, which probably enticed a lot of people to sell it, and a reversal straight after that. So by now, we are more confident that this is probably a bullish market, and the rest of it was just keeping an eye on that reaccumulation and trying to find entries based on it. And the entries came into play from the 15-second time frame. I need to put this in replay mode again, just so we can see that a little bit easier. So let's go to the 15-second time frame right now. After we started to move above the minor structure points and above that 15-minute institutional candle, on the lower time frames, we started to see we are completely taking care of everything. The market is very well trading into the important institutional candles or inefficiencies or whatever it may be. And the last institutional candle that was left open was this one over here. that was the final sell candle that mitigated the previous institutional candle in the middle of the range, and then we had a strong rally away from there. Hence, we wanted to have our first entries at the high of that range with the stops at the low, and these were these first trades. Following that, we had a 30-second re-entry, so this was the 15-second documentation for the entries. Again, I'll zoom in a little bit over there if you want to have a look at the date and time for yourself for your backtesting. And this is where the 30-second came into play. Once we mitigated the 15-second institutional candle and moved away, everything was bullish in this case. We had many confirmations from the weekly time frame down that we could be looking at a bullish market. Hence, we decided to take more entries at the 30-second time frame over there based on this final institutional sell before buy. Entries at the top of the range, stops at the low. Remember, we are looking at very low time frames. In this case, we don't need to necessarily target the 50%. We don't even need to reach to the 50% of the open price. The top of that range would do. Hence, these 30-second entries were based on the 30-second high of that institutional candle with the stops at the low. And that's where these 1.7 pip stops came into play. So let's zoom out, take this off replay mode. And that's it. Those were the 15-second and 30-second entries, which resulted in this move, which just before market closed, we achieved a 1:82 risk to reward ratio on this specific position. Majority positions are closed, and the rest of them will just keep running. They're at break even, stop loss is in profit. We have nothing to worry about, so we'll just ride it. And if it goes higher, then happy days. If it reverses and comes back down, oh well, it is what it is. You know, we will still be completely in profit in this specific scenario. And the final screenshot was about a secondary reaccumulation that took place on the 1 minute time frame as this started to go higher and higher, which is this reaccumulation that we spoke about. And if you remember, we said that this reaccumulation in a way was confirmed once we started to see this lower time frame accumulation that took place. So everything was going hand in hand. The reason I really enjoyed this setup, and it was a setup that I had to wait for a lot as well. It was a setup that required a lot of patience. If I'm not mistaken, this was at least around 2 weeks that we had to wait for it to play out and, you know, go into the desired direction. But it's worth it to have that patience. And then it's such a beautiful breakdown where you can clearly see from the weekly time frame to the 8-hour time frame to the 30-minute accumulation that kind of agreed with everything, multiple reaccumulations in the middle of the range, and mitigation of the necessary institutional candles, and boom, resulting in a very good risk to reward ratio. I know I might have spoken a little bit fast in this video, but if you have watched the Wyckoff introduction videos, and if you have watched some other trade breakdowns that I have posted on this channel, then you can see a trend for yourself now. Hopefully you have understood everything that I have mentioned. If not, just keep watching the videos, keep studying, keep backtesting more and more and more. But with that being said, I hope you have gained value from this video. I hope you have gained some breakthroughs from this video. And the most important point I want you to take away from this video is, instead of telling the market what to do, and by that I mean identifying, for example, some type of an institutional range in the market and expecting it to come here before it goes higher, let the market tell you what it's going to do. Pay attention to the schematics that are being formed and to the structure points, and pay attention to what the market is telling you and take your trades based on that. Manage your trades accordingly. Look where we have manipulated rather than where we might manipulate, and look what has taken place after the manipulations. But with that being said, if you have enjoyed the video, then make sure to press the like button down below. If you're new to the channel, press the subscribe button. I've got a couple more very interesting videos to end the year, and in 2021 I will continue to produce content for you all as well and help you all elevate. So welcome to the family and welcome to the community if this is the first video that you are watching, but I'm looking forward to everyone's growth. Let's elevate and let's catch some pips.